Now, joining me from New York City with more on all of this is Joyce Chang. She's Global Head of Fixed Income Research with J.P. Morgan. And Joyce, thanks so much for joining us. You just heard Sue's report, China issuing a new reform plan last Friday. What strikes you the most about these plans?
Well, since the last 5-year plan was issued, China has been very consistent that what they are striving for is more sustainable, more modest growth. And we've actually taken down our growth forecast for China this year to 7.6%. They are trying to avoid some of the issues that they've had with overcapacity, non-performing loans. And what they're trying to do is make sure that the state sector of the economy is not the key driver. Investment isn't the key driver. That they shift towards a more domestic demand-driven growth model.
And you mentioned that. Is this going to reverse that trend? Will this work in that way?
Well, over the longer term, we see Chinese growth coming down closer to 7%. And as I mentioned, we've taken our growth forecast down, but we think this is a healthier pattern for the Chinese government to pursue. There had been concerns about real estate bubbles, about the growth of NPLs in the banking system. And what they're trying to do is lower the size of the state sector in the economy and make sure that domestic demand is a bigger component of growth going forward. So this is an adjustment. It's a major shift for the leadership, and it's a major shift in the way that they are messaging. They are really messaging that higher growth alone is not the strategy. They also want social stability. They want to prevent asset bubbles, and they also want to make sure that the shadow banking system is under control.
You're talking about major shifts. One of the things that came out of Su Yuting's report there was the gentleman saying that the government monopolies. Now, that would be a big change if you see that. Is that likely?
It's going to happen very slowly in China, but I think the shift is a very important one. And I think that even as some of the growth forecasts have disappointed, the Chinese government has sent a message that this is actually a very deliberate decision to make sure that we have more balanced growth in China that's not so dependent on the major state-owned enterprises. So this will happen slowly in China, but it's a shift that they have been signaling since last year, and under the new leadership, they have sent the signal consistently.
What impact is the middle class going to see as a result of all of this, would you say?
I think that for the middle class, it will be a question of whether there's less savings and more of a stimulus to domestic demand factors. And I think that's a change that will take some time in China, just given the lack of safety nets that they have in some of the social sectors. But I think the key concern for the Chinese government right now is making sure that the wage and the employment numbers remain stable, and also that that their role is not necessarily going to be the key driver in a forward-looking model.
What about the private sector decisions on investment and pricing? What do you see there?
Well, I think that China is trying to send the right signals that they're going to go about this in a slow and a gradual way. They're not going to do major liberalization that would encourage hot money inflows, particularly with the actions that's been taken from Bank of Japan. I think there's more caution in the region overall. But I think that what you will see is a gradual shift that will occur over a period of time, with growth coming down from double-digit levels to 7%, 8% numbers. That's what we're seeing this year. And basically a message from the Chinese government that they don't want it driven as much by the state-owned sectors.
Let me ask you this. Is this a good model? You keep talking about some of the changes that are coming, and it's going to be a slow trajectory, so to speak. Is this the right course?
I think it is the right course because clearly there had been overcapacity in some of the key industrial sectors. The market had gotten very accustomed and conditioned to seeing double-digit growth in China. And the Chinese government has to be very careful to strike the right balance so that they prevent asset bubbles from occurring. And we have seen more pressure, upward pressure on housing prices over the last few months. So I think this is the right message, to send the message that even if growth is slowing, this is something that's deliberate. The Chinese government's going to take a very consistent stance, and that they are concerned about more than just the growth numbers. They're concerned about the shadow banking system. They're concerned about asset bubbles, and they're concerned with proceeding with modest and gradual opening of the capital account in China.
Joyce Chang, taking time out of your busy holiday to join us this evening. We certainly appreciate it. Thanks so much.